Get the latest Zacks research, analysis, and rankings on exchange-traded funds in Exploring ETFs. Here now, we're going to present for your consideration a possible way that you might be able to invest similar to the way the hedge funds invest. Nina Mishra, our ETF research director, is going to explain. Is that possible?
Yes, that is possible. Now, hedge fund industry is huge. It has about 2.4 trillion in assets, but it is usually restricted to very wealthy investors because of the minimum capital requirement, usually more than 250,000, and there are restrictions on withdrawal too. That you cannot withdraw your capital easily. Plus, it is expensive to invest in hedge funds because they charge 2% asset management fee and 20% of the profit as they take the 20% of profit also. So
that's why they make all that money.
Yeah, exactly. And plus, most of the time, most of the hedge funds, they do not justify these steep expenses because their performance is usually not that good. In fact, many hedge funds underperformed the S&P 500 last year. But there are some hedge funds which did very well. And there are a couple ETFs which provide access to the best ideas from those best hedge fund managers.
Okay.
And
that's how the retail investor, the average retail investor, is able to do that.
Exactly. And how that is possible, that is made possible, it is because of SEC rule, which requires all hedge fund managers having more than 100 million in US equity investments to disclose their holdings on a quarterly basis. It's a form called 13F. It's a publicly available document. So these two ETFs that we are going to talk about, they are like copycats. They just copy the best ideas of these best hedge fund managers, and they have been successful in that strategy, doing very well.
All right, well, show us what you're talking about.
So the first ETF that we are talking about is from Global X. It's called Guru Holdings ETF. The ticker is GURU. So again, as I mentioned, it looks at the quarterly filings and takes the best ideas from the best hedge fund managers and invests in those securities. This one was launched in June 2012. It has been able to attract about 566 million in assets so far. It charges 75 basis points in expenses. Returned about 35% last year. Very good. It has been outperforming the market since its inception.
And the next one is called ALFA Clone. Because that's really what we're talking about here.
They're cloning.
They're cloning,
clones,
right?
Imitators, so clones. So this ticker is ALFA, ALFA. This was also launched around the same time, May 2012. It is much smaller, has been able to attract about 60 million in assets so far. Uses the same kind of strategy, using a proprietary rules-based methodology. It scores the hedge fund managers, called clone scores, and tries to get the best ideas from them and invest in them. Now, this has also a built-in hedging methodology. So if the market goes down, that hedging methodology kicks in. So usually it is long market, 100% long, but when the market is going down, it becomes 50% long and 50% short. That is the hedging methodology built in within this ETF. It is a little bit more expensive, charges 95 basis points in expenses.
And that hedging methodology can help guard against extreme volatility in the
market,
right?
Exactly. If you are afraid about sudden declines in the market, then probably this one is better than the first one.
So comparatively speaking, you want to show us how these compare to what?
To the broader market. So on this slide, I have the comparative chart. You can see that S&P 500 returned about 26% in the last 1 year, and both these ETFs returned about 35%. So that's a very good performance. And as we were discussing between these two ETFs, which one is better? The first one that we talked about, Guru, is a bigger ETF, slightly less expensive, 75 basis points in expenses, has a larger trading volume, so trading expenses are low. But the second one, which is much smaller, a little bit more expensive, has this hedging methodology built in. So it depends upon you. If you're worried about market declines, then probably the second one is the better to go. But if you think that you can manage your market timing, then the first one is obviously cheaper.
And when you say bigger, is it bigger because there are more constituents in it or because there's more money invested in it?
More money.
Okay.
In terms of assets and under management.
Okay. So, you know, I always ask, do you own either of these two?
I don't.
All right. Check out more ETF information, commentary, educational information, you name it. It's at the ETF section of Zacks.com. If you're not there already, get on over, link to it off the homepage and check it out. With Nina, I'm Terry Ruffalo.